Okay, so this is going to be the practice midterm 1 for the Wednesday night class, not Monday Wednesday class, but just the Wednesday night class. We're going to project financials, a pro forma model for using the percent of sales method. There are problems with using percent of sales method, but we're still going to do it. So sales are going to grow at 10%, so equal to the sales from last year times 1 plus the growth rate right here, and press F4 because I'm going to lock this down. I'm not going to add the parenthesis here because if I hit that twice, depending on the version of Excel, it will do different things, but if I hit that twice, it comes up with the parenthesis just like I want it. Cost of goods sold, I'm going to have minus. I think I may have given you this as a negative number and one of these rates is a negative number. I should have given these as positives. I didn't catch that. I like them as positives and then put the subtraction in. So that times sales. Now this comes up with another thing we can think about. I could make this a positive number and then subtract it, or have it as a negative number and add it. I don't care which one you do. I'm doing it this way because I'm doing it this way, and it makes Excel a little bit faster to do it, I think. Alright, so the interest paid, I'm going to have interest paid. That's going to be a negative number. I'm going to take the interest rate on debt, make sure you get the right one, interest rate on debt. I'm going to lock that down times my debt. But here's one thing you got to think about. This is the debt from this year. Remember, a balance sheet's a snapshot. I don't know what the number is yet. I'm just going to have that blank cell because I'll figure it out eventually. I'm going to take the debt from this year and last year, add them up and divide by 2. And the reason I'm doing that is balance sheet's a snapshot. So I don't know how much debt I had during the year. I only know that at the end of the year I had these two amounts. So I'm making a guess of what my average debt was for the year. My guess will probably be wrong, but it's going to be close. I'm projecting the future. You're going to be wrong. You don't have to be perfect. Alright, so that minus 16 is a bogus number right now. That's okay. We'll find it later. Same thing with the interest earned. So I have interest, I have cash sitting in an account somewhere. I don't know what that account looks like. I don't care right now because I'm told wherever it is, it's going to earn 8%. So I take that 8%. Well, how much cash is in there? Well, last year there was $80. This year, I'm not sure how much there's going to be. I mean, that's predicting next year, right? So I add those up and divide by 2 and say that's the average cash I had during the year, because the actual way I earn interest is going to be on my daily balance, and I can't predict a daily balance. I'm just going to say end of this year, end of next year, take the average. Alright, depreciation, what do I need to do with that? I'm going to say pretty much the same thing here. I'm going to have some depreciation rate, F4 times, I'm going to take the gross fixed assets. This fixed assets at cost is gross, so what it will be next year plus what it was at the end of this year divided by 2. That number again is bogus. My earnings before tax, I add these up, I do Alt equal, and there they are summed up. If I had these as positives and need to subtract them, obviously I'd have a different formula here. Taxes is going to be minus, of course, paying that tax rate, so F4 times the earnings before tax, and I can do the Alt equal here to sum these up, and Excel's going to guess wrong, so I just take my cursor and tell it exactly what I'm trying to sum up. Dividends, dividend payout ratio, negative again, F4 times my net income, and then my retained earnings. Remember, net income is either paid out as a dividend or it's kept as retained earnings, so I just add those together. I take all of this and I copy it across, and those are the projections for the income statement that are completely wrong because I haven't done the balance sheet yet. Alright, I want to turn one thing off, so let me pause the video real quick. I gotta make one adjustment. Okay, so when we do the balance sheet and the income statement, we're always going to have what's called a circular reference. So I turned off the thing in Excel that takes care of that issue so you can see the issue arise. And we'll work these numbers kind of in a little bit of maybe an unusual order. It's just the order kind of what I'm thinking of here. So I'm going to leave cash off for just a second, and I'm going to say current assets. Current assets, I'm doing this because they are listed as a percent of sales. So F4 times the sales, and I can go ahead and copy those all the way across. Net fixed assets, it's the same thing. It's going to be as a percent of sales. So net fixed assets divided by sale, F4, multiply that times my sales. I can copy that all the way across. My total assets, I've already done that here. You add up the cash plus current plus net. You're not required as a company to show this cost and accumulated depreciation. So remember, the actual total assets are cash plus other current assets plus net fixed assets. Okay, what about this accumulated depreciation number? Where exactly does that come from? Well, it's going to be last year's depreciation plus, but I'm making this a negative number, so minus, I did that as a positive, as a negative, so plus this negative right there. So well, like I said, this number is not right because I still have stuff to fill out here, because I don't know my interest paid and my interest earned yet, right? Because I haven't figured out what cash I have. I need to know the cash before I can know interest paid. I need to know the interest earned before, I need to know the debt before I know interest paid. I need to know the cash before I know interest earned. I don't know those yet. So all these numbers, everything's still not right. But with gross fixed assets, or the assets at cost, I know gross minus accumulated is equal to net. So I can say this minus that negative, and it gives me this circular reference. Why does it do that? Alright, so Excel's saying, look, you screwed up, pal. So let me look and see what's going on here. I haven't screwed. I have, but there's a simple fix here. So the gross fixed assets, in order to know those, I need to know accumulated depreciation. In order to know accumulated depreciation, I need to know my gross fixed assets. Right. So that didn't quite work. Let's continue with this though. And before I copy it over, I'll just let Excel, have a little fit with that and see what happens next. Current liabilities, they are as a percent of sales. So there they are. F4 times sales. And debt and stock, we're making the assumption here, for this particular case, it doesn't always happen, that they're not going to issue any more debt or any more stock. So their debt and their stock or their equity are going to stay the same. So now I can copy these across. With a spreadsheet, you're always going to have a plug number. Well, what is that plug number going to be? In this case, we're going to make it cash. Okay, what about their accumulated retained earnings? It's going to be last year's retained earnings plus this year's retained. It's going to be the accumulated retained earnings from last year, plus the actual retained earnings from this year. That gives me a zero. We still have some issues going on here. We'll see that be taken care of a little bit later, so nothing to panic with just yet. We can panic later. And then my total liabilities and equity, just sum those up. Okay, but what about the cash number? Where does the cash number come from? Cash is my plug. It's going to make the balance sheet balance. So if this is 1,000, this has to be 1,000. So what I do, I say equal to the total liabilities and equity minus my net minus my current assets, and that gives me another circular reference problem. So what do? I can't do anything other than guess, right? Because I have to know one number to get the next number, and it's not going to work out. So I come over here to Excel options, I go to formulas, enable iterative calculations, click OK, and Excel works it out for me. So now I just copy these across, and I copy these across, And now I hope everything is worked out correctly. Am I confident everything's worked out right? No, not yet. I need to check through and make sure I haven't made mistakes. There's no back of the book. I need to check all these formulas and see that they work, or I need to do this enough to feel real confident in it. So what I'm going to do is I'm going to look at, because we actually have the answers here, I'm going to do a couple of checks, and you can go to page 135 in your textbook, and rather than checking each individual number, let's go and check the retained earnings. If the retained earnings are right, and particularly this last year, because that's the final number, if that's right, it's 211.2, the book shows 211, but the book doesn't go to decimals, I feel good that that's okay. Now I come down here to my total assets in 1941, it says in the book, but I'm 1940.5 if I round it off, it's 1941. So I feel good about all those numbers. And then if I want to feel better, I can go through and check more individually, but those should work out right. Alright, so what about the free cash flow calculation? Where is that going to come from? Well, I don't need to do it for the current year. I don't really care about that. I'm trying to predict future years. So here's how I do it, and I'll walk through the logic as I do this. Think of them as a corporation as a money machine. So a money machine needs to generate money. Free cash flow is how much money is being generated to all the shareholders, all the stakeholders, shareholders and debt holders. So the first thing I do is I see how much net income this thing is producing. My net income, 246. But that's not a real number, right? Because I've subtracted depreciation. So let's go back and look at this. I need to make this negative because I have a depreciation expense up here. So when I see this depreciation expense that's been subtracted out before I have earnings before tax, which deducts my taxes, that's not an actual cash flow. That's just me telling the government I made less money than I really did. Legal, but that's what I'm telling them. So this net income figure, really cash-wise, is I need to add back that depreciation. So I do that. To make the money machine run, and this is kind of the money that the money machine has generated, to make it run, I need to put in working capital and fixed capital. Working capital consists of my change in current assets and my change in current liabilities. So I go here and I look at, now let's think about the sign here. My current assets went up by $15 from 150 to 165. That's like an increase in receivables, and it's the increase in inventory. So if those numbers increase, if I increase inventory, think back to 3300, that's costing me money. So I reverse the signs here, and that's actual negative 15. And the logic for our current liabilities is the opposite. An increase there is positive cash flow. And for gross fixed assets is the same thing. If that number goes up, I've bought plant, property, and equipment, so that is a negative cash flow. Alright, what about the interest paid? How should I do that? And this is after tax. I should have the term here after tax. And the reason I want the tax out of this, I'm looking at what's available to all my shareholders, I use the term shareholders, all my stakeholders. So I could completely redo this firm and change the amount of debt and the amount of equity if I wanted to. So I'm trying to see what's available for everybody here. So I've subtracted the interest I paid on debt. I'm going to add that back. So I use that as a negative up here. Right? But I'm not going to add, that was taken off before tax, right? So the after tax, so 1 minus, and my tax rate is 40%, F4. I hit the wrong button, change the brightness. Here we go. And I didn't hit the right button. Now let's go back and try again. This thing about laptops. F4, close parenthesis, and that's right, 19. And then I have this opposite problem here. with interest earned, I'm going to come back and say earn this amount of interest. I'm going to subtract that and do the after tax, so 1 minus the tax rate, and press F4, and my total free cash flow, Alt equal, there we go, it's roughly 176, and then copy all these across. And I feel good about doing this because that number 228 is what matches the book. Real life, I would probably want to do much more checks because I don't have the book. I'm going to skip the statement of cash flows. You can just walk through the book with those, hopefully, and do that pretty easily. I want to go to the valuation portion. So what I'm going to do down here, because I'm going to do something a little bit different than the book, I'm just going to get the free cash flows from up here. I'm just going to copy these across, and this works like the non-constant growth dividend model. This is a cash flow not that's paid as a dividend, but the cash flow that's available. It's a cash flow that the money machine is generating each year for the next 5 years. And after that point, after 5 years, I'm saying, look, I can't give any more precision here. I'm just going to say it goes to constant growth. So I could get these dividend payments, think of them as dividend payments. I could get those for the next 5 years, and then I could sell the machine. When I say the machine, I mean the corporation, the money machine. And the price I would get would be the cash flow from the next year. So the cash flow in year 5 times 1 plus my long-term growth rate, which is right there, divided by K minus G. In this case, K is our weighted average cost of capital. And so those are the cash flows I would get. The book used net present value. I don't like that. I don't like using net present value. I like showing the individual present values. So the value of that cash flow next year is equal to that cash flow divided by 1 plus the WACC. Lock that down. Raised to the power of the year. Now I can copy that across. If I do that, I'll leave off this terminal value here. Make sure you understand order of operations and have the parentheses around that. Come here, close parenthesis, and that's the value today of receiving those future cash flows. So if I come over here and I'll press Alt equal, and Excel guesses the wrong thing for me to sum up, but it's easy to me to tell it the right one. And there, that sums up to what it should be, the 1230. And now I get to add and subtract a couple of things. So what I'm going to do is say, all right, that's the total enterprise value, and I'm going to add back cash. So I'm adding back cash, and let me tell you what's wrong with doing this. Here's my current cash I currently have on hand. And the reason I do that is I'm saying this represents the cash that will be generated in the future. This is the cash I'm holding right now. So I'm going to say the total asset value are those two added together. The flaw with that is I need part of that 80, if this is in thousands or millions, probably, think millions. I need that $80 million to generate the future cash flows, to make the money machine run. I don't need all of it. I need part of it. So I need to add some back, but I don't know how much. That's my excess cash. So we're just going to do it all because I can't. This is a fictional company. I'm just going to do it all for this point. And my debt. So now this is a total enterprise value with the cash added back in. So I want to find what the equity is worth. The total value of the firm is the debt plus the equity. So the total value of the firm minus the debt, which is, I should just do minus the debt and do this one step at a time. Minus the debt value, which is currently 320. So Alt equal, add these together. That's my equity value. So now if I want to do a data table and I want to do it with equity value, click right there. And I want to have these numbers, and what I want to do is have a start value, because I don't want to have to type these in if I have different firms. So I'm going to have a start value, and I should label this, for WACC or something. I'm not going to do that now. And I need to have this in percent. So I'm going to say, let's start it at 15, and I'm going to have an increment at, let's say, 2.5. So since I'm doing that to one decimal place, I'm going to add a decimal place. So this is going to be my start value, and then my increment, oops, what am I doing? This should be equal to that plus my increment and F4, and now I copy across. I want you to notice one important thing. These numbers over here have absolutely no connection to any other number anywhere on the spreadsheet. That's important. So now when I do this weighted average cost, when I do the data table, come over here, insert, data, what if analysis, data table. What's the row input? I have weighted average cost of capital. I go to this one because this is what I referenced to get these numbers, which gave me that number, which gave me this number. For my column input, I reference this because this gave me that number, which gives me this number, which gave me that number. Click OK. It fills them all in. If I had made a reference from here like this, I would have wrong numbers, and it doesn't look like it should be wrong. This is still 20%, but look how those numbers are different. It's just a little flaw in Excel. It doesn't do it right. So always have the numbers here, these choices, either type them in individually or have them referenced to something that looks like this. Constant growth, well, I'm going to do that quick. Constant growth is going to be next year's dividend, or free cash flow in this case, divided by K minus G, and then it's the same process from here on out. So I'm going to stop the video at that point.